what your credit score is, or are you afraid to look? Today, we're joined by credit expert Brian Quinn to break down the biggest credit myths, what actually moves your credit score, and how to become mortgage ready. Because small mistakes today could cost you thousands tomorrow. So stay tuned as we dive into all of that and more. Well, happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk about everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we are sitting down with a special guest of ours to break down what really matters when it comes to your credit score and how to get credit ready for your next home purchase. But before we get to that, as always, a little coffee talk with the Joes. Joe, I understand there's something you want to talk about this morning. I'm a little
There
afraid.
is, there was a huge holiday this weekend, right? Huge. It's called Valentine's Day. Just kidding. It's not a good holiday, but it's a hallmark holiday to remind us one thing. We have loved ones. We need to at least celebrate them. So if you're only doing it one time a year, please step up your game, guys, and do it a couple more times a year. So that way you don't have to celebrate on one day and go out and pay the high prices for flowers and everything else. So the reason I wanted to talk about this, Joe, is, and people that have watched this show, we talked about why we moved to Nebraska, a lot of it to do with family, being closer to family, and then my daughter, wanting to kind of grow in herself. We were over at my brother's house on Monday.
Yeah.
And I know Valentine's was Saturday, but on Monday, we're over at my brother's house, Tina and I over there hanging out with family. That's why we moved up here, because Anna was having a Galentine's. All of her girlfriends came over, and we had 11 other girls here celebrating their togetherness, their fun. And it was just driving around the corner and seeing all these cars at our house for my daughter was awesome. Love it. And all of her friends are fantastic. And I know you have said some similar things with Sam about this stuff, or Samantha. Yeah. I always call her Sam. So Sam. If she watches this, Sam. That's what I say. But, that was the best feeling on Monday to come home to that. So I was just excited to talk about it today, too.
And it is. I mean, all of us as parents, to be able to see our kids grow into their own and build their village, as I call it, in that development, especially during the teenage years, because that's the toughest, right? And to be able to have her develop that after what? You guys been up there in Nebraska how long now?
So Anna's been up here since August of 24. Okay. And then I officially made the move after Hunter graduated in June or July of 25.
Last year.
Yeah. So in a year, she's made a ton of friends.
Awesome.
One thing I want to put out there is if anybody is watching today and, you want to make comments and things like that, today's show kind of wraps in what Joe and I were just talking about, our family. And what we're talking about today is credit and everything else. And I know we're going to get into the show here in a second, but drop some comments, drop some questions today, and let's have an interactive show. I mean, we've already got people listening. We've got more listeners already, Joe, than we've had in the past couple of shows. So I'm excited. Brian's bringing some good people in for us.
Speaking of which, I am super excited to be able to have the guest on our show today. Actually, I'm excited just to have a guest on the show. It's been so long, Joe. So I don't know why. I always thought we treated our guests pretty good, but it's been a while since we've had a guest. And it's been a while since we've had Brian on. He is a senior credit analyst, nationally known credit expert with nearly 20 years of experience in the credit industry, helping people in credit restoration, debt negotiation, and consumer credit education, most importantly. Please, everyone, welcome to the show, Mr. Brian Quinn.
Hey guys.
Well,
Hey Brian, how are you doing, sir?
I am doing excellent this morning. I'm really glad you guys have me back on the show. So I'm excited to share some knowledge and answer some questions and help put some more folks in homes.
We've changed up the intro since you've been on here. We actually, Joe does a great job with those videos and the music. So I'd love a little bit of feedback about that first from you. And then also tell our viewers, I know we've had you on here before, but tell our viewers a little bit about yourself, about, not just what you do, but your company a little bit. And so that way they know who you are. And then we'll share Brian's information at the end. So if anybody's needing to get in contact with him about some of credit questions, that way he can help you guys with that too. But Brian, I'm going to turn it over to you. Tell us a little bit about you and what you do.
So guys, I'm a senior credit analyst over here at the Phenix Group. I've been in the credit industry. Coming up in May will be my 19th year. And I really love what I do as far as everything. I like being able to help people, get through their financial situation, through these rough patches in life, or whatnot. And a lot of this does base back to education on how credit really works or whatnot, because it's really not there's likely a reason for that, but that's a whole nother conversation we could have later. But to win in any game, you've got to understand the rules. You need a solid playbook. You need a good coach. Otherwise we're really just, set up for failure. So, I work with lenders like the Joes here, real estate agents, mortgage professionals that at times may come across borrowers that, maybe went through a little bit of rough patch in life. It happens to us all, but are back on their feet now and really need some direction in how to get their finances back in order to become mortgage and loan ready. So, and like Joe said earlier, I really do harp hard on the education part of all this. I really think having a great foundation, just like in sports and life, it's really needed.
Yeah. Well, you already have some fans. I see that Joe's been sharing. Yeah. Justin Huff, always listener, love that guy. And
hey, Justin.
Jonathan Bolden. I don't know if you've had the pleasure of meeting Jonathan.
I have. Yes.
Good. He's saying what's up. We love it. Thank you guys for participating. But Brian, we have you on today to talk about some of the myths that are out there, right? Let's start there. Joe, I'm going to turn it over to you because I know you wanted to ask the question on this one first. So I'm going to go back to you.
Well, Joe, you and I always love busting myths,
Yes,
whether mortgages, real estate, anything, but especially today and kind of busting some credit myths in that. So I wanted to ask so that all of our viewers know directly from Brian, what's the difference between a soft credit pull and a hard credit pull? And does it hurt your credit?
That's a great question, Joe. So a hard inquiry, or a hard pull, as it can be referred to, is where you're actually applying for financing, whether it's a credit card, a loan, an auto loan, or a mortgage. Lenders are trying to gauge potential risk. So too many of those in a short period of time can make a borrower look risky. Now, a soft pull is where you actually view your credit yourself just to pretty much see what's on there, or you go to a lender like you two to get a good idea of where you stand, as far as that. That's correct, Joe. You guys can run a soft inquiry to figure out exactly where they're at.
Yeah, we do that. Supposed to be doing that every time, is starting with a soft pull. Then when you're ready to issue a pre-approval, that's when you'll look at doing the hard pull if they're making an offer and things like that. But we start with soft pulls, one, credit, but also we can get those at a cheaper cost. So it lowers the cost when it comes to doing loans for those clients. When it comes to soft pulls, Brian, in your opinion, does it give all the information that a hard pull gives?
Kind of froze there.
Oh, man.
No.
Hey, could you repeat the question, Joe? We glitched out.
Back now?
Back.
I'm going to have to call my internet provider. I swear. I actually stepped it up, and now I'm having a problem. My question was, on a soft pull, does it show the same amount of information that hard pulls show for our viewers?
Great question. It depends on where you're getting how you're doing a soft pull or whatnot. different monitoring sites. Some are better than others. Annual reports, do have a lot of information, though they lack scores or whatnot. I recommend, using a good monitoring site like Experian.com or MyFICO. I think it's a good idea to look at your credit at least once a month for a few different reasons. Number one, we want to see exactly, what's on there. Sometimes we can, have some surprises. I had a borrower the other day that when the lender did a soft pull on there, they found out that there was several collections on there. Turns out that it was actually an issue of identity. So in this day and age, it is a big deal. So, seeing that, and figuring all that out is really important before we begin the loan process.
Well, you bring up a good point in regards to using different resources like Experian. That a lot of people out there look at like Credit Karma, or their bank may offer them a score. How relevant or accurate do you feel those are?
So scores are going to be privy to what we're applying for. So when we go to a lender or whatnot, they're going to extract the information from the 3 credit reporting agencies. There's different algorithms they put that information through to gauge the risk in said item. So if we're applying for a mortgage, there's a mortgage model. If we apply for a credit card, there's a credit card model. There's several different auto models. But when we look online, they're using, like, for example, like Credit Karma. Credit Karma uses the Vantage 3.0 model. That's not used for mortgage lending. It's really not used for much lending at all. So sometimes the figure is much higher, sometimes it's low. So as far as like your actual credit score when you're applying for a mortgage, you're not going to get an accurate number right off the bat on many of your banking apps. Now, Experian.com does give you your FICO 2 mortgage model, which is a great way to gauge. MyFICO, a little bit more pricey, but it'll give you the FICO 2 for Experian, FICO 5 for Equifax, and 4 for TransUnion, which is exactly what you guys are going to see on the mortgage side. So just depending on what site you're looking at. But if we're looking at Credit Karma or banking apps, it's just not accurate whatsoever when we're applying for.
So all of our viewers out there, I see we've got quite a few online right now. Being that we're talking to the expert today, please drop any questions that you might have about your credit in, because we can address them right here live with Brian to get the answers that you need. Yeah. So any questions, comments, drop them in for us.
And you can keep it very general. You don't have to say, my credit, I missed a payment on this. You can say, hey, if you miss a payment, what does it do? We're going to get to some of that too, probably today. But I don't know. I'm going to apologize again. I keep feeling like I'm locking up. So if that happens, I know Joe will take over, keep talking. We kind of go back and forth that way. But Brian, when you talked about the different types of credit scores based on, like Experian, you said go there. I think it was Experian, where it'll give you a mortgage score. What is the differences between the rankings on the type of loan, real quick, like from a mortgage to an auto to a credit card and things like that? So like,
I'll give you an example, Joe. If I'm trying to refinance my current vehicle or buy a new vehicle, banks are they're trying to gauge risk. So if I have late payments on my past auto loans or a repossession, it's going to have a heavier effect in that auto model. Same with a credit card, same with a mortgage. If I missed a payment on my mortgage last month, my mortgage score is going to be pretty low because of that.
Yeah. I don't think I've ever thought of it in those terms of it will base it directly on what type of loan you're doing. I know mortgage always has a little lower. If you don't have a mortgage, you're not going to have a lot higher score, than somebody that does have a mortgage and making the payments on time. So that makes more sense to me now. But it looks like we have a comment there, Joe, if you want to take on that.
Yeah, Brian. Absolutely. From Brian, our buddy Brian. Will not mention that he's a Seahawks fan because we don't want to diss him too bad. But he does ask here for us, Brian. Many of our current borrowers are unaware of the student loans. I think this is a great question.
It is a great question.
We're in deferment are now reporting late, sometimes 12 months or more. Is there an easy fix or recommendation, or do these need a full rehab, like missing a year of credit card payments?
depends on how far delinquent they went and what loan servicer. So what's happened over the last 5 years or so during COVID, they placed everyone's loans in a temporary forbearance to help everyone out. But at the end of 2024, they pretty much, said, hey, we've made it through COVID, now we need to start repaying. And where a lot of borrowers, made the mistake in their FAFSA account, they may have had old information in there, old address and old email. And when they were contacted about, repayment, they didn't receive it. And, time goes by, we're not really paying attention to our credit. We find out, hey, we're, 90 days past due, 180 days past due. If it gets too far, gone, the situation could get really bad. It's not just your credit you need to be concerned about now. The U.S. Department of Education, it's backed by the Treasury Department. That's where the money comes from. It's like owning the IRS money. So they can attempt to garnish your wages. They can levy bank accounts. If you have a tax return coming, they're going to take it. But, a rehabilitation program, when it gets too far gone, is a great option for the buyer, where they'll have to deal with the government issued collection agency, which is known as debt management, where when you enter into the rehabilitation program, you have to make a set amount of payments to them. And then if you successfully complete that probationary period, more or less, they'll transfer the loan back over to the U.S. Department of Education as a new loan, and you get to establish good payment history. There's different options depending on who the loan services are, what the circumstances are, or whatnot. So, if you do have any buyers that are running across those situations, I'd love to talk with them. Sometimes, a little bit of advice, on there can get them back in the right direction. But it's definitely something we do not want to ignore. The situation could get way worse, let alone not only destroying your credit, but we can really wreck our financial situation as well.
Well, a lot of people didn't understand that after that deferment, some of the student loan companies, when the government lifted the where you can't report late payments, they sent out a letter. And if you weren't checking your mail and actually opening them up, all of a sudden you didn't know that deferment is not there anymore. And then all of a sudden you're 90 days past due, and you haven't even, it wasn't even a full 90 days because in your opinion, you never saw the letter. We've had a lot of clients that has popped up when they're trying to get pre-approved. And, they working with somebody like you, though we've had some success getting those taken care of when it first happened. But now, if it's been about a year, I think, since that all started. So now I don't know if a year later that they would do that and help out on the credit. So getting with Brian is very important.
Yeah, when that first happened, there was some of the loan servicers where you could literally call and go, look, I didn't know. And some of them would backdate the payments. I haven't seen much of that going on lately. So we've got to explore, different options now about that. I would recommend, if you do have student loans and you did, for whatever reason, put them in any sort of forbearance or deferment, figure out when that payment is due. As adults, it's our responsibility to know when our bills are due. And what I was saying earlier, when I refer to your FAFSA account, that's the National Student Loan Database, pretty much tracks everyone's loans. If you go on that website, you can see all the history of your loans, and figure out where all that stuff is. I highly recommend making sure that you do have all of your updated personal information in there, because just like Joe said, if they send a letter to a wrong address or whatnot, and you never received it, and you don't make the payments, they're going to mark you late, regardless.
And all of this is great information. I appreciate Brian Pollard asking this question, because it all revolves around, getting someone ready, mortgage ready, for the future, whether it's next month, 90 days, 180 days from now. In doing so, what are some of the things that, in getting people mortgage ready, I think the key, correct me if I'm wrong here, Brian, is really, what are the underwriters going to look at primarily?
Understand, if we break down credit in its simplest terms, It's what's the likelihood that someone's going to pay on time and their ability to pay back, right? So underwriters are paying attention to a couple different factors here. 35% of your credit score is your payment history. It's the largest section of our credit right there. Just like when we work all week, we expect a paycheck at the end of the week. So do our creditors. Next factor they're looking at is your credit utilization on your revolving account. So our credit card balances. What's the limit versus our current balance? Anytime I run up higher on that limit, the way underwriters are going to look at that is that, maybe why is Brian not paid down his credit card? What's going on here? Who in the world wants to pay 30% daily interest? This guy must be financially struggling. Even if that's not the case, that's the perception that the underwriter sees. The docs and the credit score, they're going to feel that maybe, it's just not the right time to look into buying a home because I'm not in a good financial situation. It's very important to keep, our credit card balances as low as possible. 15% of it's going to be our average length of credit history. Having a strong credit profile over the years shows that you have a track record of borrowing money and paying it back successfully. When we're new to credit, we're considered a little riskier, or as you guys may refer to it, when I may have like one credit card, and that's it, or maybe an auto loan, it's considered a thin file. So, which brings us into the next part of our credit. We're wanting to see, several different types of credit and how I've managed it over the years. New credit is 10% as a 10% factor as well. They're looking to see how much financing have I been taking out lately. So this kind of goes into the hard pull, Joe. If a lender runs my credit and they see that I've been going to every bank in town asking to borrow money, it's not a good look. The first time I heard this said, it said reason for lower score, too many inquiries the last 12 months. And then under it, the description was desperately seeking financing. So, ouch, that
hurts.
That's harsh, right?
Yeah,
it is very harsh.
But at the end of the day, look at it this way. If you had a really good friend that asked you to borrow money and then you found out that he had just borrowed money from all your other friends, you may wonder, hey, what's going on with this person's financial situation? Can they pay me back? Or am I going to be the last guy on the totem pole to get paid back? So underwriters are looking at this, engaging that seriously in risk.
So it sounds like the three main areas the underwriters are looking for is utilization, payment history, and really recent activity. Correct.
Number one's going to be payment history. We got to pay our bills on time.
Okay. All right.
So you might mention like, if you miss a payment or you have a collection, things like that can hurt it. So what about settling or disputing? Tell me the when you would either settle versus dispute different things when you're.
Got to be very strategic with that, Joe. Okay. There's a time and a place to dispute and audit a collection agency or a creditor, something that's unfamiliar. Maybe it's something from the past or whatnot. But let's say we have we fell behind on our auto loan or whatnot just last month. We know we were late. We know it. And if we don't catch up on this or make right on it, the scores are just going to get lower. Look at it like having like we're all in a boat right now and there's a hole in the bottom of the boat. If no matter how many pails of water we scoop out, if we don't plug the hole, the boat's going to sink. So with that said, that's an example when you would want to, make right on an account. If we have maybe I have a credit card that, maybe, business was slow during the holidays and I, couldn't make the payments on it, or whatnot. And it got into a charge off or collection status. Couple things, it's brand spanking new. And like Joe was saying, we're looking for recent activity. Something like that, happening is lenders look at it as severely risky. It's best to work out a settlement at that point, or whatnot, or pay back, what you owe.
What about medical? Because that's one of the big ones we're seeing.
Froze out there, Joe. I heard medical. Is that what you said?
Yeah, I'm sorry if I'm locking up or.
Oh, no worries. You know how computers can be, man.
Yeah, medical, because we have a lot that pop up, collections, medical, and you get, all the different collection companies that buy it over and over and over. So kind of, is that one where you might look at settling those more than you would look at trying to dispute them out?
When we get into the collections, especially, collection agencies are very, very unethical companies. In the state of Texas, you don't even need a license to open up a collection agency, which, when you hear that, it's a little alarming, because if I wanted to become a barber, I'm going to have to get a license through TDLR in the state of Texas. But debt collection, no big deal. So what's really common with debt collectors is where they may buy off old debts or debts that have been passed from hand to hand, where they're too old to be on the credit report. It's being reported in a manner like it's brand spanking new, and it's something that happened 5, 6, 7, 8 years ago. The more recent something is on your credit, the more it hurts you. So it's a false assumption of risk. Go on, and sometimes you'll have collection agencies that will literally illegally tack in fees on top of the actual debt that wasn't stipulated in the contract you signed. It's illegal. Most folks don't know that. But understand, with the credit reporting agencies, they're just large warehouses storing data. So when creditors and collectors report information to them, they're managing everyone's credit. There's like 350 million people in the country. They don't go back and check this stuff. They take their word for it like it's the gospel until you can show them otherwise. So when we see some of these unknown collections, you're not familiar with it, or med bills, stuff like this, going back and actually auditing these creditors for the actual validation of the debts, important. Then we can figure out, if there are any sort of legal violations or inaccuracies that we could leverage to get it removed permanently. Or, it might be, oh man, yeah, that was when we, took my daughter to the hospital, and yeah, I got that bill and I was gonna pay it, but I forgot. Well,
or the hospital didn't put our insurance on file and didn't actually file it and made it self-report, self-pay.
I've actually had that too. I've actually had that happen.
Yep,
I got a bill in the mail when I had diverticulitis back in 2012 or 13, and I went to the hospital. They ended up having to admit me, CAT scan, bunch of procedures. Got a bill in the mail for like 25 grand. And, I immediately called it, and I'm thinking, what in the world do I have insurance for? And when I asked them about it, they said, well, sir, we tried to bill your insurance company. You're not insured. And I said, what insurance company did you bill? And they said, Blue Cross Blue Shield. I said, well, I haven't had Blue Cross Blue Shield in many, many years. I gave you my new insurance card. They're like, well, hold on a second, sir. And they went and pulled it up. They billed the correct insurance company this time, and then I paid the difference.
So let me ask, it looks like we're getting a little frozen in different pictures here. Brian or Joe and stuff.
Brian keeps freezing. I keep freezing. Joe, you're the only one that hasn't frozen.
I think, I'm the only one that's got decent internet today. But all of this is really, trying not only to get people mortgage ready in buying their next home, but I think very importantly, I want to discuss, while we have you, Brian, for only a couple more minutes here, what really moves the needle in credit scores for people?
The quickest way to move the needle with your credit score is to look at your utilization. That's going to be the fastest way to increase your score. If I come to you two to purchase a home, and you guys do a soft pull, and we see that, a couple of my credit cards are, running higher up on the limit. If I was to pay those down immediately, we could use strategic pay down markers on those cards to give me my most bang for my buck. That's going to update on the next billing cycle, rather than battling back and forth with certain collection agencies. And there's a lot of folks out there that may have a lower credit score, and they do have some negative items or things affecting them. But just paying down the credit cards alone can bump the score up high enough to get a mortgage.
What about, because Joe and I see this quite often on credit reports, that someone is an authorized user on some other credit card or debt. How does that affect things?
It's a double-edged sword. Authorized users can be a great way to help your kids, build a financial future, or whatnot. However, when you put an authorized user account onto a credit card, that the primary borrower is financially responsible and liable for all transactions, or whatnot, you're getting to piggyback off their credit, in certain situations inherit their good credit history. But why I say this is a double-edged sword is because if said person that puts you on as an authorized user falls behind on hard times where they miss payments on it, guess what? That's on your credit now too. If they've racked up a balance on that card and do not have the ability to pay it down, now we're running higher on utilization. Now, what we're just talking about here is 35% of our card score and 30% of our score. It's a big factor.
Yeah,
now, you did inherit 15% age in credit, but the payment history and utilization far outweigh that. Aside from this, Joe, one thing that I've noticed more and more frequently on the mortgage side is that some underwriters don't like authorized user accounts and don't want them on the credit report. Is that kind of what you guys are seeing as well?
That's where what you're talking about there. If they have good credit and they have established trade lines, and there's an auth user and they're an auth user on another one, and it's typical to their credit, underwriters don't have a problem with that. But if that author user is the main thing that's driving your score up, and you don't have any other credit cards but that one, you don't have any other trade lines, underwriters are going to make us that removed, redo your credit, and that causes a lot of people not to qualify at that point. So
it really goes back to
the double-edged sword,
trying to gauge risk. If you were to put me on as an authorized user on one of your credit cards that you've had long outstanding great history on, over the years, I'm fresh to credit and I don't really have, much credit at all. Maybe I've been paying cash for years.
Mm-hmm.
The underwriter, they're concerned on my ability to repay said mortgage loan, not Joe's credit history. They're worried about mine. They're not lending Joe money. They're lending me money.
Right. Well, listen, we are out of time. We're over time. I knew we would be because there's just so much.
I could talk about credit all day,
here.
Joe.
I know we could go on another hour probably.
How do any of our listeners get a hold of Brian, Joe? I don't know if we have it typed out, or if Brian, if you can give out your email address or number or whatever, if they want to get in contact with you, because like Brian said, he can talk about credit all day. That's his expertise. You need to talk with somebody like this if you're having these questions and you're wondering what's going on with your credit. So Brian, tell our viewers how they can get a hold of you.
Several ways to get a hold of me. You guys can email me at brianq at the THE and then Phenix, which we spell Phenix without the O. So it's PHENIX group.com. You can call me on my personal cell phone, which is 214-620-4713. Now, I do get text messages on this phone as well, so feel free to text me. My office landline. Now, this number does not receive text. Sometimes I have some borrowers that will text this and I don't get it. So the office line is a landline. It's 469-290-4622.
A lot of great information here, and I appreciate everyone with their questions, their comments and stuff. And matter of fact, just real quick, because Brian Pollard can attest to this, right? No, don't show that one. I am not going to let Pollard know that. No, I'm not. Yes, this one. Best way to set up borrowers is with Brian. Text him, email, phone call. Definitely get a hold of Brian for that. Thank you, everyone, for listening in. And Brian, thank you so much for coming on our show. We appreciate all the insights that you were able to give our listeners out there. Truly do. If you have more questions, please reach out to Brian. He's the man. He's like the Yoda of credit. So reach out to him for all your needs. Next week, tune in as we have another special guest next week, Eva Ray from Compass Realty, as we go through the ins and outs of assumable loans, which I think is a great topic to discuss. A lot of people don't know about assumable loans, and we're going to dive deep into that. So tune in. Even better still, be sure to subscribe to our YouTube channel over at YouTube at The Mojo Show Real Estate Podcast. And matter of fact, while you're there, hit the subscribe button, because we are on a mission to get to 1,000 subscribers. So every like, share, and comment helps us reach really more homeowners like yourselves. So before we close things out, any last words or nuggets of advice for our listeners, Joe?
Just want to say thank you again to Brian for coming on. And if you're having credit questions, get a hold of Brian over at the Phenix Group or another professional in your area if Brian's not the one that you want to contact. But this is very important for you for your future because it saves you on everything if you have good credit.
Absolutely. Oh, Joe, you popped yourself off. Look at that.
I accidentally hit that instead of mute.
I'm Joe Mortgage, and that handsome guy with the beard is Cup of Joe Mortgage, and we'll see you next week.